Jones is the way to go. Call 706-5000.
Hey everybody, Jared Jones. Today I'm joined by a special guest, Jason Cota with Fairway Mortgage. And Jason Cota is actually a long-time veteran of the industry. I've personally worked with him for approximately 4 years. And as a 20-year veteran broker, that kind of tells you that the lending piece is a very crucial part of our partnerships in real estate. So when you're selling homes, you can't take your client to a lender who blows up transactions. It makes you as a real estate agent look really bad. So the fact that me and Jason have worked together for that long, and the background I have in the real estate business shows you that, he stood the test of a lot of years and, dealing with a lot of our customers. He does a fantastic job, but more importantly, his opinion is important to me because he's been doing it a long time and I see the professionalism he has with my clients. So I want to hear what's going on. A lot of you are noticing, and a lot of you that are exposed to real estate now or are considering buying in the future are wondering what's going on with the interest rates and what's going to happen with the market this year. Because if interest rates rise, then the payment that you're pre-qualified for goes up, and theoretically, buying power can go down if interest rates rise. So essentially, you were pre-approved in December, and then interest rates go up half a point. Then all of a sudden, your pre-approval drops $25,000. So all of a sudden you can't buy the homes you were shopping for a couple months ago because, if interest rates are changing, it could dramatically affect you. So are the changes happening across the board? Are we going to see a future of rising interest rates? Are we going to see the market change as a result? We're going to try to dive into all those questions today, but just wanted to welcome Jason to this market update. And Jason, what's going on, man?
Hey, Jared, thanks for having me. Not a lot, just getting the new year started here, obviously with some changes that we've seen on the lending side from the end of the year starting to really carry over to current, which I think are going to affect, as you mentioned, buyers in several ways. One, based on monthly payment, and two, ultimately qualification.
Hey there, Jared Jones, the voice behind this video, and it's not a secret that real estate investors from all over the planet own homes in Central Florida because our cash flow is very high. And our particular investors here at my company, nestshare.com, and our investors are making more than ever. If you've given any thought to expanding your investment portfolio, we help you find and locate high earning cash flow properties. We help you turn those properties and prepare them for the market. And we also take care of all the tenant management as well as property management needs month after month while you collect the earnings. The homes we're talking about sell in the $300,000 to $400,000 price range. Many of them, it's not uncommon to see them gross per month over $5,000 in income. And the great thing, that even if the economy takes a hit, if there's any kind of recession, this model will likely only get even sweeter. For more information, visit flcashflowhomes.com. That's flcashflowhomes.com.
So what we've seen, I guess, to dive into it and give you a quick breakdown, we've got two different factors that are really going to be driving rates that we're seeing right now. One is the immediate, which is what we've been all anticipating, with inflation being, I believe, the highest since the 80s at this point in time. The Fed is changing their monetary policy, which was, initially purchasing bonds to inherently drive rates down. With them changing that policy to ease off of that, we've seen the market shift along with inflation to pushing rates higher. As of today, we're probably seeing the highest rates that we've seen since March of 2020. Now, With that being said, not to scare anybody, but they're still phenomenal rates. I mean, pre-pandemic, we were looking at 4.25% to 4.5% interest rates on average for well-qualified borrowers. Today, you're sitting at probably about 3.5% due to the market and economic changes that we're seeing.
So obviously they've shot up. Have you seen the rate increase affect all mortgage buying segments? So when we say mortgage buying segments, is this just like our first time home buyers seeing their rates higher? Are people that are in the move up category who are putting 20, 30% down for primary residence? You have investment property and second home buyers. Obviously Florida and nationwide, a lot of the market growth that's happened in our economy has been driven by investment and second home purchasing. So obviously that is huge. If that starts to get really expensive and those investor buyers are not there anymore. So are you seeing the rates that went up on the 30-year market, do they change or they impact any market segments in a more higher impact way than the others?
I mean, we've seen, several buyers, because a lot of people in this market, I believe, you're pushing with the lack of inventory, we're seeing, a huge surge in value, and people are having to adjust with that. With that being said, a lot of people were towing their line financially with what they wanted to or could afford. From that standpoint, yes, because 0.5% in interest rate is moving a payment, $200 to $300 depending upon the loan amount. So either, we have buyers that no longer have the affordability themselves, even though they may qualify, and other buyers simply that don't qualify anymore because of that. And that's why we want to kind of get this information out, because, sitting on the fence to see what happens, well, we're kind of in the middle of the eye of that storm right now.
Right.
What we always typically see is when news comes out is the speculation in and of itself, and most markets move this way, right? When information is released before the action is even taken, the markets will react. And that's what we're seeing, not to say that the rates won't calm a little bit. From most of what, I pay attention to, what I listen to, and Barry Habib with MBS Highway is a huge contributor of somebody that we follow quite a bit. He actually projected, 2 weeks ago that we were going to see this kind of movement. And, historically, he's always right on point. What they're assessing right now is we're going to see rates probably in the mid threes to possibly touching 4%, depending on your credit qualification. And then hopefully in the second half of the year, as everything settles, maybe come back down to the mid to low threes, but nonetheless be higher. So a couple things with first-time home buyers, there's still low down payment programs, but again, your buying power, as you'd mentioned, is going to be reduced with higher rates. And there are some other things that, when we get later on in this segment, that we can touch on that outside of just the economic movement that we're seeing, that FHFA, which is Fannie Mae Freddie Mac, that they are going to be making adjustments that will additionally impact home buyers on interest rates, depending upon the program and type of property as well.
Gotcha. Yeah. And if you're watching the video, you're like, I'm not buying a house, I own a house. One thing you need to understand is that whenever interest rates rise, the buying pool is still there. It's just affected by a rate change. When a rate change is affected, the size of the pool of buyers for your home immediately changes. So like, for instance, if everybody, you find yourself in a $450,000 price category, a $350,000 home value, and you're presenting your home to that market, all of a sudden the rates go up 0.5%. Most buyers shop at the top end of their buying power range. So if the lender says you're pre-qualified for 350, an inflationary market, they shop for every penny they can borrow because the money's cheap, and then the houses they can afford are dramatically smaller than they used to be because they've gone up so fast. When the interest rate rises, then all of a sudden, if you had 40 buyers that wanted to buy a house at 350 on your street, that immediately shifts to like 25 or 20. It just changes. Now, obviously, we don't get really detailed about this. People that were in the buying class above your house that were buying it, at 400 when you're at 350 might have dropped into to fill their place. But nonetheless, there's going to be, in my mind, the prediction is if you own a first-time home buying house, if you're selling a home to the market that will be marketed to first-time home buyers, that's going to have a chunk of the foundation of the marketplace drop, that say, this is now at a point where you have to price reduce to sell it. Possibly, it just depends on the size of the market for those homes and the economy around it. Every marketplace is going to be affected differently, right? There's going to be the increase in interest rates are going to affect home values in certain marketplaces where there's not high demand already, right? There's just like Pittsburgh, it's been flat for 2 years. It's the same, it didn't spike, it didn't go down. Those marketplaces are going to see a change. And so Florida's got high demand for their homes. There might be specific categories where you see the marketplace suffer a little and prices roll back, but like we have so many people wanting to buy here. If anything, it's just going to, unfortunately, probably squeeze certain buying classes completely out of the market because the rates are going to go up. And that's one thing. If you are considering buying, and you're in a hot market like Florida, the interest rate climbing is the worst thing for you because you are already in shark infested water, so to speak, when trying to purchase. So
and it could affect, I think, buying power. If we're talking about a dollar amount, just to kind of give everybody an idea here, typically $300 and $350 swing in monthly payment equates to anywhere from $35,000 to $50,000 in buying power.
Right.
So that's going to shift you down a little bit into a different category. So you're getting, less for more in some instances. But nonetheless, I mean, this day's been coming. There's opportunity. Again, nobody's got a crystal ball. But with the expectation that rates may come down later, you may be in a position that, don't sit on the fence now because rates have come up. They're still really great, still
Right.
historically low. You should be excited if you can still get, a 3.5% interest rate, because I mean, listen, everybody would have liked to probably got Bitcoin at $100, but that's not the case anymore. Doesn't mean it's still not a valuable asset if you can obtain it at a fair price. But down the road, if what everybody's kind of projecting to happen in the second half of the year comes true, well, then there's an opportunity to maybe refinance and drop your rate back down to 0.5% and take advantage then. But don't miss out now, because what home prices probably are going to still continue to rise because of lack of inventory, regardless of what, which way borrowers move up or down in their price point because of rates. So I still think that it's a good time to get in. Again, we're probably at least 1% lower than where we were pre-COVID.
Yeah. And I think a lot of times as a buyer, when you hear this news, you're sitting there thinking to yourself, okay, well, if interest rates go up, then there's going to be a price correction to match. Like if all the buyers drop down, then if I hold out, I got to pay 0.5% more on my interest rate, but I'm going to wait 6 months and time will build in this price reduction. Well, here's the thing. If you're buying in Florida, that is not going to happen. Okay. Because we already have, we're the #1 relocation destination for 2021. It's not going to change this year either, in my estimation. Like demand is ridiculously high. So what happens is, there's just going to be, replication of the buyer. So essentially, if this buyer falls out, there's another buyer take their place in a market like ours. And then you're relegated to the rental market, which is projecting to go up over 7% nationally. Florida's going to beat that trend at like 10%. Renting is a bad plan. You're going to be faced with inflation. So I agree with the buyer that says, hey, you know what? Maybe my market will drop. That is true on the market you're in. If you have negative demographics or flat demographics in your neighborhood where there's not this inflow and outflow of people coming and going, and the market's pretty stable as it's been, then there's going to be with interest rates rising, there's going to be some baked in price correction, most likely in that marketplace. Sure. But that takes time too. So there's a gamble of time because it never happens overnight. Price correction with interest rate change is usually like a moving train. You don't slow a train in 30 seconds. A train takes time. It's been going on a path. The marketplace, needs time frame for sellers to get adjustments made, things of that nature. So in the marketplace we're in, I'm going to tell you that as a buyer, I think the biggest challenge for us this year is you see interest rates go up and you've been shopping at one price point. And like Jason said, now all of a sudden you're down 30 grand. And I'm the bad agent telling you, unfortunately, the prices are still going to climb because demand is high. And so you are faced with looking at a little lesser house than you were. And psychologically, that is it's very tough. Sure. I'm going to tell you, get in where you fit in, like get in what you can get that day. Because if you do not get to the ladder, it's going to keep rising. It's like you've got to get on where you can and then rise. When you lock in your price and buy a house, you build a position of equity so that you can get to the next property that you wanted in the first place. Some people are like, they want to buy the house that's the home of their dreams the first time, and they hate moving and they never want to do it again. So they want to buy the perfect home. You can't. In this market, I'm telling you, psychologically, you need to plan on just getting something. Change your definition of success in the market with rising interest rates. The definition of success needs to be, I'm going to get something because it's all worth more a month later, as opposed to being locked out and watching it go up a month later, and being more disappointed as time goes on and the market runs from you. Okay. So, define what good news means in this market differently, because, you definitely have more headwinds. And that's unfortunate because, as a buyer, we're not here to paint rose-colored glasses on you with the idea that it's going to be easy and all that. It's not. You need emotional stamina to do it. And unfortunately, changing interest rates are still not, it's just a challenge that we have to help you overcome as professionals, for sure.
Exactly. Well, and to your point, I mean, we've got the largest demographic of home buyers ever in the market right now, in the millennials. I mean, there is more home buyers coming into the market now than ever. I mean, it's, again, still a good time to buy. Like you said, get in while you can, because that's only going to grow.
Sure. So are loan limits changing at all? And any, like, are they still shifting? I know that's been a lot of the response to helping buyers, purchase properties in an inflationary market. Like, is that still happening? Has it happened recently with like, I guess, conforming loan limits, stuff like that?
Yeah, so conforming loan limits have changed. The conforming loan limit this year is going to be 647 to 50. So that's what you can go up to and do a minimum of 3% down
Wow.
as a first-time home buyer.
Gotcha.
So
Gotcha.
VA, you can still go as high as you'd like, regardless of the conforming loan limit. And then obviously FHA is going to have, their new loan limit. I'm sorry, I think I said 647, 250, it's 647, 200.
Gotcha.
But FHA is going to have theirs as well. So there are new adjustments for this year, which is, I think, in part what's going to bring us to kind of the next piece with FHFA, not to be confused with FHA. Some of the changes that are coming with the interest rates internally to push price points up. As I think, we see these price points rise, I mean, the level of risk for, the insurers of these types of loans increases. Also, what we've seen in the past couple years being with low interest rates are more individuals buying second homes, right, and pushing price points higher. So there's some changes coming down, but yeah, loan limits have definitely increased. There's FHA does them county by county. So you really have to speak specific to each and every county for them for the most part. But in general, their conforming limit this year is 647, 200.
Gotcha. Awesome. Is there anything else that you want to share about product cost and things of that nature with regards to different loan types that are out there?
Yeah, sure. So that was the second piece to what we're going to be seeing in rate adjustments. And this is probably the biggest piece, I think, prevalent here in Florida, with the amount of people that come and buy second homes, mostly as vacation homes. Anybody looking to do so in any state for that matter. But I think this one relates mostly to where we're at, is the adjustment to second homes from FHFA. Now, those home changes are going to be quite significant. Again, the risk level that they're assessing, I believe, and they haven't come out and definitively stated why, but they're looking to a large number of people that are holding these second homes now. And if a market were to ever shift, the first home you probably let go of is not the one you full-time occupy.
Right.
If it's an investment property, you have income coming in, but we're talking about a true second home where you're carrying that mortgage. So there are what they call risk-based or loan level pricing adjustments. These are the adjustments that ultimately determine the rate that you qualify as a consumer. And not to get too much into this, because it's really not going to, it'll bog everything down for everyone. But the main thing to focus on is that these adjustments, based on your credit score, the type of property, the location, the down payment, there's always these marginal adjustments that ultimately determine what rate you qualify for. It's not just always credit. But the adjustments are going to move significantly for second homes. They can move anywhere from a 0.5% margin adjustment to 4.5% margin adjustment. So what we're talking about, how does that impact rates? That can move an interest rate anywhere from 0.75% probably to 2%. Wow. On the rate that you qualify for. So that, last year we've been fortunate up until this point, you could purchase a second home with 10% down and really get the exact same rate within 0.1% maybe of what you would get for your primary residence.
Yeah.
That is about to change, which again, also ultimately will impact your buying power. That's set to change here probably in these, probably in about a month from today, in about mid-February. Those changes are going to come into effect.
So is second home going to be, is there a chance where you're taking a second home occupant buyer and shopping them with a complete non-owner investment loan at that point? Or I guess is that, and I don't want to say anything out of school, like you're like, Jared, we can't even do that. Like to me, it's like, it's the same thing, but like maybe for you guys, it's not, I don't know.
Yeah. Internally, so Fannie Mae and Freddie Mac require that you at least occupy the home for some portion of the year. Some of the guidelines can be gray.
Gotcha. Okay.
Really, I think with Freddie Mac, the guideline is 1 day you must occupy. So
Uh,
then
I
after
guess
that,
the
they can
question,
allow you
I
to
guess
Airbnb.
the question is, which rates are second home rates going to be higher than investment loan rates?
It's possible. We haven't
The
seen the
same
full
buyer?
change rolled out yet, but in theory, yes, they could be in some instances.
Wow.
It
That's
depends
incredible.
on your qualification. Again, if you're the investor putting down for, again, not to get into it too much, but the magic number for investment properties is really putting down 25% to 35%. That is going to get you the best interest rates.
Gotcha.
So depending on the scenario, it might end up where you have a worse rate than, the person looking to buy an investment property.
And all these rates are, I mean, like you said, historically really good, but there's, the point is there's some tightening. The easier, lower cost interest rates are changing slightly. They're just a little, they're still low, but they're not as low as they've been.
No, and for other areas, I mean, in Florida, we've got the conforming limit at 647, 200. Anything above that becomes a jumbo loan. Now, in some other areas of the country, for anybody else, not looking in Florida, what have you, but where you have what they call high balance areas, there are similar adjustments to high balance loans as well. So it might be the case that obtaining a jumbo loan might be a better rate, which typically always wasn't the case, than these high balance loans, because
Right.
it's really the two types of loans that FHFA is targeting.
Gotcha.
High balance loans and the second homes.
Gotcha. Last question, a little bit left field. I heard a friend of mine on from another large company, real estate broker, say that they have a loan product where you could buy your next home. So you own a home now. You want to go buy another home. You buy it with a mortgage, and then they don't kick in your payments for like 6 months to allow you time to sell your current house. The sales pitch on that is obviously being that with the marketplace being so fast, right? I want to go buy something else, but I'm afraid if I list my house, it's going to sell really fast. I won't, I won't have time to buy the next house. It just takes really hard to do that on the next side of things.
Yeah.
So thinking that through, have you heard anything about that? That might be a niche product that exists through some private investor that might have only be doing one of these a year, or is it something that you've heard about?
Yeah, I mean, that product's existed for a little while.
Stop it.
Yeah, it's just not used as much because people have been able to get in homes pretty quickly. I mean, I don't know if it's exactly 6 months. Every product's a little bit different because those are niche products, as you mentioned.
Sure.
But there are products, and the qualifications are going to be a bit different because they want to see that you have the reserves to carry the primary mortgage until it gets sold. But a lot of times, people would write offers using those programs to be able to not write as contingent. Not that you can't even find the other home or have time to sell, but just so you're not writing contingent. And they, based on your assets and credit, they allow you to be able to qualify in that fashion. So it might not be the exact same program, but there is a similar program for individuals to do that. I'd have to look into the specific on any one scenario, but any other additional information you want, I'm happy to get it out to you.
Yeah, that's interesting. So there is a product that you can actually, you can buy your next house and then get relief because you're obviously paying a mortgage on your current house. And then obviously, you're going to sell it inside of 6 months in all likelihood.
Well, a lot of people are using that money from the sale of their home to buy the next property.
Correct.
Right.
Yeah,
So
that's a good point.
There are certain benchmarks you've got to hit to qualify for that. Like
Yeah. So you actually have to have cash down and you don't have your equity out.
Yeah, and that's why the assets is a pretty big part of it, right?
Yeah.
But they do allow it. Now, as far as do you get to hold off on not making a payment on one of them for 6 months? I'd have to look into the particulars on that.
Yeah, you can.
But if one mortgage company has a niche program, most likely it's out there that everybody's offering it. Nobody's going to have one program for that long without the rest of the market catching up, right?
Understood. I was curious. Yeah, and like you said, there's going to be there's going to be a downside to it. It's going to be either maybe you have to have already 50,000 saved up for the down payment on the new one, or
you may end up, you're probably going to end up with a slightly higher interest rate because there's a certain level of risk that the bank then is assuming.
Yeah.
Right. Because what if the other home doesn't sell for as much?
Maybe it's a 6-month reverse mortgage, and then
there are some cool new programs out there, though. There are ADU programs out there now that you can do renovation to add ADU to your property.
What's ADU?
An accessory dwelling unit.
Oh yeah, ADU.
Yeah, so there are other properties, programs out there now that are allowing people to take their rentals to be able to do like, you know, a renovation
Guest
or
house.
almost add those to your property.
Gotcha. Okay. Interesting. Well, awesome, man. You got anything to add before we jump off here?
No, like I said, I think that if anybody has any questions on where you sit right now, you know, definitely reach out to us and let us know.
For sure.
I would not sit back and expect rates to go any lower. Not to say that they're going to shoot much higher, but again, as we've all seen, you know, they're not going to be sub 3 forever. We've been saying that for some time, and we're kind of in that eye of the storm, as I'd said before. But you know, even if the projection of them dropping second half of the year is in place, don't miss out on the home prices you can get today, for the sake of, you know, something that may happen in the future. You know, definitely I would act now, contact Jared, you know, get in touch with us so we can help put you on a plan to get you into a home sooner rather than later, because rent is one thing that is not going down anytime soon.
For sure. And Jason's number has been on the screen the whole time, and contact information as well. So reach out to him if you have direct mortgage questions. And as I mentioned, he's awesome. I couldn't said it better myself, Jason. Appreciate you coming on and kind of enlightening us on what's happening next. And we'll get you on an update later this year.
Appreciate it, man. Thanks for having me on, Jared.
Thanks.
It's me again, Jared Jones. Home sellers, have you given any thought to selling? At the Jones Group, we sell your house fast, no spring cleaning, no showings. Call today to get your instant offer. You set the closing date and start packing when you wish. Investors, once again, if you're looking to buy a high earning income property in the Central Florida area, we take care of acquisition, any repairs, and helping you with property and tenant management end to end taken care of for you. Visit flcashflowhomes.com for more information. Home buyers, thinking of making Central Florida your next home? Call the Jones Group first. Even if you're several months out, we'll take you by the hand, hear your story, look at your goals, and make sure you have complete clarity and a path that's going to land you on your goal so that you get it right and only move one time and never have to move again if you choose not to. Also, keep in mind, we give you a rebate at close from our commission on any new home you purchase. Thanks for watching. Once again, like and subscribe. We'll see you on the next one.